Hello everyone and welcome back to another episode. We are going to talk in this video about all of the stocks that I'm currently watching in this little bitty dip that we're having in the market with the Evergrande situation. There's lots of stocks that I'm watching that I'm currently interested in adding positions to, and I want to go ahead and show my portfolio, so go ahead and take a look. This is Fidelity Investments. This is my portfolio that I currently have. Now, if you've seen this before, this all looks familiar to you. These are the 5 companies that I'm invested in, but in today's video, I don't want to go over any companies that I'm invested in. I want to go over companies that I'm currently watching that I do not have a position in. So, key takeaway here, I don't own stock in any of these, but these are all companies that I'm wanting to get invested in. So I hope you guys enjoyed this video. Check out any links down in the description down below, including investing material, referrals to M1 Finance, Robinhood, Webull, all that great stuff. But thank you for watching, and let's go ahead and tune into the very first stock. The very first stock here is Rocket. Rocket Companies is one that I just made a YouTube video about. They are very innovative. They are growing. They are growing top line revenues. They are growing bottom line earnings. The management team is incredible. They are extremely innovative. It's just a company that I love as an investment. I think that they're a growing company in a growing category. I think getting home mortgages through mobile apps, through online services in general are growing, and I think that it's going to continue that way for the next several years. And so Rocket Mortgage is one that I think is perfect to take advantage of that opportunity. If you take a look at the year chart here, let's go all the way back to when they first went public. Like I said, they went public, let's see, what is it? They opened up at $18 a share. This company went public at $18 a share, and today it trades at around $16. If we go ahead and zoom into recent price movements here, ever since after that big spike up on the Wall Street bets movements, it's pretty much just been a downtrend. It has never come back. Now, will I think this company come back long term? Do I think it'll go back to the high teens, to the 20s, maybe even in the 30s back again one day? Absolutely I do. I think that at $16 a share, I believe, in my opinion, the company's undervalued. I showed in my last video how the forward PE of this company is dirt cheap, and I think it's about time investors start piling back into the stock, and hopefully I'm able to build a position if I'm able to raise some capital. There's a position I'm currently looking at selling out of, or at least lowering my position in, so I can maybe make a little bit room for Rocket. So hopefully I'm able to build a position in Rocket, and let's go ahead and move into my next position. The next stock that I'm potentially thinking about buying is one that's very similar to Rocket, and that's Zillow. Now, if you've ever been online and looked at any real estate website whatsoever in regards to buying or selling a home, it's probably either Zillow or one of the websites that they currently own. Once again, let's go ahead and take a look at the year chart here on Webull. The all-time high just set back earlier in February 16th of this year. So what was that, about 7 months ago? This stock traded at $208, and today it currently trades at $94. So Zillow has literally been cut more than half in price. We're looking at about a 55-60% downturn from its all-time highs just set about 6-7 months ago. Now, Zillow is once again another growing company. They do have a little bit of a high PE. They are growing that bottom line pretty quickly though, but more importantly, their top line revenue growth for a growing company like Zillow is still growing quite nicely. People are scared of the fears with the housing market, very similar to a Rocket Mortgage, and I think it's a good one to be taken advantage of right now, in my opinion. That's not financial advice. I'm not a licensed financial advisor. I do not have a position in this yet. If it drops lower, that's when I really start to get interested, but it's already at a pretty hefty discount. The valuation is starting to get pretty attractive, and it's one that I'm watching. Now let's go ahead and get into the next position. The next one that I'm really doing more research in, I feel like from what I've seen so far, I've read over a couple of the quarterly reports, their 10Ks, and I started to glance over their 10Q. I haven't really went all the way through it yet, but so far from what I've seen on this company, and forget the stock price for a second. The last year or two for the stock price has been quite tremendous. Let's see, bottomed out in March, April of last year, bottomed out around $4. And just the other day, it was all the way up in the 40s. So this is one of those companies that if you could have bought around the lows of last year, you could have 10 extra money in a year. This is one of those stocks that really just blew past me. I didn't give it the credit. I saw a lot of people recommend the stock to me last year. I should have gave it the time of day because I never really did the research, because I heard a mattress company, who just wants to buy a boring mattress company? Well, apparently a lot of people, because the stock has been doing tremendous. From what I've seen from the quarterly reports, it seems like they're constantly sold out. They're trying to consistently build out factories as fast as they can. The financials are pretty good for this company. And also another thing that's really cool is that they're vertically integrated. Much like when I own like a Tattooed Chef. Let's go to Fidelity here, for example. Tattooed Chef is a company that is vertically integrated and is what I believe is one of the main catalysts for why I think they could be more profitable in the long term. Now the same thing goes for Purple Mattress. They're vertically integrated. They do all their own manufacturing, a lot of the branding, all that stuff. And it's really one that I think is interesting. So they're growing quickly. They're pretty profitable. They have a lot of consistent customers that continue to buy more and more of their mattress products, including even things like dog beds. But purple is one that I'm really interested in, and I have alerts set for under 22, where I really think the stock starts to get interesting is under $20. If it's under 20, that's when I'll really start to consider buying a position in this company. But let's go ahead and get into the next stock. The next stock is Visa. I've talked about Visa so many times on both my old dividend videos and also on my growth channel. I mean, Visa, it's just, I'm convinced, and I think I've mentioned this before, in terms of strictly the business model, I think that Visa has literally the best business model on the planet. They're a dividend payer, consistent dividend grower. They, I think, like I said, I mentioned this before, maybe other than Apple, I think they buy back more shares than any other company on planet Earth, buying back shares at ridiculously high levels, which helps boost that earnings per share number. Top line and bottom line growth is ridiculous. The financials are fantastic, so well capitalized, and it seems like this company's doing acquisitions for billion-dollar companies, what seems like every other week. Visa is one that we all know and love, and it is likely one that you have in your pocket, in your mobile phone, or in your wallet, or even both of them, just like I do. And so Visa is one that I love, one that I really like for the long term, and it's hit an all-time high earlier this year. Let's go ahead and look on the Webull chart. Let's see, what day was that? July 27th of this year. So about 2-3 months ago, they hit an all-time high of 252 and some change. Now since then they have dipped, and right now they're currently trading at 222. So a dip of about $30 a share, about, what is that, 10-15% or so. So they're finally in correction territory. Who knows how much lower this one will go, but from what you've seen in the past, if we scroll to the left side on the chart here and zoom out, you can see that Visa doesn't have a whole lot of times where it ever dips. I mean, when you're buying Visa, it's pretty much a straight line up. Ever since the Great Recession, it's pretty much just been a straight line up ever since. And because I love their business model so much, they're so extremely profitable. If I were a betting man, I would say that that's probably going to continue. So let's go ahead and get into the next stock. The next stock is Beyond Meat. Now Beyond Meat is one that I have been a shareholder of before, just recently. I sold out of my position when I transferred everything over to Fidelity because I needed a little bit more money to round up to my 500 shares of Corsair Gaming that you can see right here. But Beyond Meat is one that I really want to get back into. I sold around the 130s, I believe. I think it was 132 if I'm not mistaken. But Beyond Meat has traded down to 113. Now Beyond Meat is really starting to get attractive in the low 100s again, but if it were to go say below $100, that's when I really start to say, wow, Beyond Meat is starting to trade at a pretty good valuation. Now, in terms of valuation, it does trade rich in the sense that the company has really started to concern me in how profitable they'll really become. I know that they've had deal after deal after deal come through, including a lot of their major McDonald's deals, and this company seems to really never turn a profit, which is a bit concerning, but the top line revenue growth and the market opportunity for Beyond Meat is ridiculously large. I mean, the TAM, the total addressable market for this company is so big. I mean, really, it's anybody that eats, which is everybody. This company could sell products to pretty much every single human on earth, and they're in a growing category, which is the vegan/plant-based space. And so I think that Beyond Meat is set up for some really big potential to take advantage of that market. But Beyond Meat starting to have a little bit of a dip here. If you look in terms of the stock price, since it hit that all-time high back in mid-2019, the stock has pretty much went nowhere. It's had some big moves up, some big moves down, but it's basically just flat. I think this is setting up for an opportunity as Beyond Meat grows bigger and bigger. They're able to improve that profitability, keep growing the top line revenue growth. It could be set up for a big run. We'll see, we'll take a look, but if it continues to dip lower and go under $100 a share, I'm really going to get interested in that stock. Now let's go ahead and take a look at the next two, and I want to bunch these up together because they're really similar businesses, except one has been hit a lot harder than the other. And one of those is Las Vegas Sands, and then the other one is Wynn Resorts. One of them has properties in both Las Vegas and Macau and a lot of Asia areas, which is Wynn, and one of them is mostly just focused in the overseas markets, which is Las Vegas Sands. Now, it's really interesting because all of what's going on with China. I know we all know the Evergrande situation, and I think a lot of these companies are selling off in fear because of that. And then also a lot of these companies have been hit really hard due to the pandemic, and their financials are not nearly as good as I'd like them to be. Like I think last time I checked, I believe Las Vegas Sands has about $2 billion in cash and about $14 billion in long-term debt, which is pretty hefty, which is about 7 times their cash on hand, which is starting to get a little bit ugly. And then I know Wynn Resorts is a little bit better than that. I think they actually have around the same amount of cash, around $2 billion, and I believe their long-term debt's around 10, so a little bit cleaner, but still not very good. That said though, their share prices reflect that. With all the worries of China, with their financials being way less healthy, and I think that those debt payments are really gonna start weighing on their companies, but that said, you're also gonna be buying these companies at some of the lowest prices you've seen in years. If we go ahead and scroll out here and look at Wynn stock, going back to 2014, it went up to all the way up to $250 a share. It's traded up, it's traded down, and then going back to say 2018, right at the beginning of 2018, there were $200 plus, and today you can buy the stock at $80, $80 a share. That is a 60% decrease from that high just back in 2018 and has recovered nicely since the pandemic, but is finally starting to see some downwards movement. Las Vegas Sands. Let's go ahead and zoom back as far as we can see here. This is pretty much the lowest the stock has traded since the beginning of the pandemic in March of last year. And so I'd be lying if I told you that there were no worries with Las Vegas Sands, because like I said, the financials are not healthy. There is some concerns with their business, but that said, if this company is able to come out and the Evergrande situation is not nearly as bad as people are making out to be, it's gonna be one of those stocks that I think will inevitably recover. It's just a matter of when. Do they recover? Oh, matter of when, that's funny. But it's a matter of when. Do they recover in share price 1 month from now? Do they recover in share price 6 months from now? 2 years from now? That's really a big question, and the valuation is starting to get pretty cheap, but it's not dirt cheap, but it is starting to get to a level I think that's really interesting. But I'll let you guys know if I start a position in either of these. Like I said, I am looking to free up some capital by lowering my position in one of them, but I'll let you know. But stay tuned for that, and I'll catch you guys next time.